Foreign institutional investors or FIIs or FPIs are net sellers for over 3 quarters now. So far for 2025, FIIs have been net sellers of shares worth 1.51 lakh crore rupees, and DIIs or domestic institutional investors have been net buyers and bought shares worth 1.6 lakh crore rupees. The markets, well, there has been a bloodbath, but on March 5th, Nifty and Sensex recovered a bit, seen in green. During the day, Nifty was up 1.23% at 22,354 points and Sensex was up 1.12%. This recovery today comes after Trump announced additional tariffs on China, and China announced retaliatory tariffs of 15% on US goods. The Wall Street tumbled though overnight following the tariff imposition. So it sounds like there is a trade fight between the two biggest countries in the world. But Indian markets have been falling mainly because FIIs are selling. What is the reason for the selling, and when will the FIIs come back? Let's understand from scratch. The FIIs sell when there is slow growth or market is overvalued, and they get better returns from other similar markets. But India's macroeconomic position is strong and the valuations have been improving too. But FIIs are still selling. As per Rajiv Batra of JP Morgan, the primary driver of FII investment in India is always been growth, not just valuations or market positioning. FIIs have been net buyers for years in India for its growth potential. This was for 4 years post-COVID. India's compounded annual earnings grew by an impressive 20 to 25%. But now, over the past year, in last 3 quarters particularly, earnings growth has dropped to around 6%. But valuations are still at post-correction PE of 19. Now, before we delve deeper, let's get an idea of how FIIs look at valuations before investing. One of the main ways of determining the valuation of a company or a market is its PE ratio or price to earnings ratio. PE ratio is a way to measure how expensive or cheap a company's stock or a company is compared to its profit or earnings. Formula is stock price divided by earnings per share. High PE ratio means that the stock is expensive and low PE ratio means that the stock is cheaper. For example, if the stock is of 100 rupees and the earnings per share is at 5 rupees, then the PE ratio is 20. Now, as we know that the earnings growth has dropped, right? So what FIIs are saying is that the valuations are high at 19 PE, which is post decline in earnings growth. So they are saying that the market is expensive and they are looking for markets which trade at lower PE but have high earnings growth, maybe markets like China, Japan, etc. Basically, the market is overvalued is what they are saying. Now, the selling escalated in November last year. In the last 5 months, over 3 lakh crore rupees have been the net sales of FIIs, and this is coinciding with changes in the US political leadership, with Trump changing a lot of things. So emerging markets have witnessed $40 billion of outflows. With liquidity tightening and uncertainty in global markets, investors are liquidating positions in the markets like India, Brazil, Mexico, Taiwan, and Indonesia, which were once favored. So Batra says that this might not be a reflection of India's weakness, but a broader trend that is impacting the global emerging markets itself. As per the expert, long-term investors are beginning to take notice, like pension funds and insurance companies are showing some renewed interest in Indian equities. So maybe the long-term perspective is still bullish. Now, when will FIIs come back? FII comeback may be triggered by easing of liquidity constraints, improved high-frequency growth indicators like GST collections, which rose by 9.1% to about 1.84 lakh crore rupees in February this year. Cement consumption and other economic data of India's recovery will be closely watched. Clear signs of policy-driven growth, the budget and monetary policy show that the concerns of inflation have come down. So all this will be closely watched. So as per the experts, FIIs may be only a few weeks or a month away from re-entering the Indian equities. Some experts see it as a potential long-term buying opportunity, and some other investors say that the market is still overvalued and it is at a critical juncture. So you need to stick to your analysis, instincts, and advice from your registered financial advisor to make any stock related decisions. For more such news and views, keep watching ET Now.
If you like this video, then like, share and subscribe to ET Now.